The United States emerged from World War I as a true global power, and by the 1920s, Wall Street had displaced London as the financial capital of the world. But US financial regulators didn't quite realize the enormous responsibility that was now on their shoulders. Over the next decade, they would just sit back as the New York Stock Exchange broke record after record and jubilant traders threw a party on Wall Street of epic proportions. The Roaring Twenties were quite the decade. Prohibition of alcohol was in effect, but speakeasies were impossible to eradicate, and Americans always found a way to have a good time. The economy was booming, and disposable income rose for all Americans by 9% from 1920 to 1929. For the top 1% of earners, it rose much faster. That's because worker productivity reached new heights, even if wages didn't, and Model Ts were flying off the assembly line. But despite the boom, most Americans still had almost nothing saved up. And some, most notably farmers, were actually worse off in the 20s than they had been in the teens. When World War I was raging, it was a great time to be a farmer. There were so many hungry soldiers to feed, and the huge demand allowed farmers to raise prices and make investments to expand production. For example, US wheat output increased by almost 50% during the war. After the war, Europeans had a hard time continuing to buy up the huge surplus that America was producing. So that's when US banks, flush with capital, stepped in to offer loans so Europe and South America could keep buying American exports. US loans were a lifeline to farmers. American shoppers also had to make do with borrowed money increasingly throughout the 20s. People ran out to buy shiny new gadgets like automobiles and radios, and modern advertising techniques encouraged this new consumerism. People's income was sometimes increasing, but not by that much. So they relied on installment credit to pay for things like cars over time, and these types of loans more than doubled from 1925 to 1929. Stockbrokers were also borrowing an increasing amount of money from Wall Street banks, who in turn borrowed from the Federal Reserve, which had the effect of fueling speculation and inflating stock values. The rising inequality and increasing reliance on debt for consumer purchases and stocks was clearly unsustainable looking back on it now. But at the time, it didn't bother financial regulators or people like Secretary Andrew Mellon all that much. Mellon was Secretary of the Treasury for Republican Presidents Calvin Coolidge and Herbert Hoover. His main priority in the mid-20s was to secure tax cuts, not to fight inequality. In 1926, he pushed for a major tax cut for the wealthy, and Congress agreed, passing it as part of that year's Revenue Act. The Revenue Act of 1926 lowered the top income tax bracket from 46% all the way down to 25%. That meant some wealthy investors had even more money to pump into the markets. Stock values climbed enormously the year after the tax cut. But Mellon would have denied any connection. He thought booming stocks were the result of real economic growth, fueled by the advent of the automobile and by the expansion of American industry. And you can argue that he was mostly correct, at least up until about 1928. On March 12, 1928, stock traders bought 3.9 million shares, breaking the record for the number traded in a single day. people began to think that the market could only go up, that it was a new era, and that the old rules didn't apply. The rising prices attracted more and more speculators to the market. These are people who don't bother to scrutinize stock fundamentals like earnings per share or the potential for long-term growth. All that matters to them are the rising prices. Speculators began to borrow heavily from Wall Street banks and funneled that money into the markets with a reckless abandon. And if you can believe it, loans to stock speculators were considered safe investments by the banks. They were considered safe because brokers held onto the stock, that was the collateral, and they also required a certain percentage of the trade in cash as well. That's called the margin. So even if the stock plummeted, the broker had the margin, and they also had the stock itself, which they could sell to recoup the loan in a worst-case scenario. The only danger was if many brokers sold all at once. That would force the stock price down even lower, eroding the value of the collateral and potentially forcing more brokers to sell. It could only fall so far before the margin would be used up, and then brokers would sell to get their money back. The presence of speculators buying on margin meant the potential of a devastating chain reaction that could wipe out the market. But as long as the stocks kept going up, yeah, it was very safe, and everyone wins. In November of 1928, Herbert Hoover was elected as the nation's 31st president, and the market boomed on the news. Republicans in those days had a hands-off policy towards markets, so Hoover's win signaled that laissez-faire would likely continue. The day after the election, 4.9 million shares traded hands. And later that month, on November 16th, the market shattered that record with 6.6 million shares bought in a single day. The market slowed a bit in December, but overall, 1928 had been an incredible year. And people looked on to 1929 with optimism. Privately, though, members of the Federal Reserve Board were worried. They knew brokers had been loaning money to stock traders for almost as long as the market had been in existence. But the volume of these loans was so much higher now than it had ever been before. For example, in 1926, brokers had loaned traders $2.5 billion. But by the end of 1928, these loans had more than doubled. That meant speculation was taking over the market. The Federal Reserve Board understood that, but they weren't sure they should do anything about it. Popping the bubble, of course, would have been easy. The problem is that popping it would cause a disaster, and even worse, everyone would see who was standing there with the pin. They'd be blamed for the collapse. So, the board set out to avoid popping the bubble. But they also didn't want to be blamed for doing too little either. That's why on February 2nd, 1929, they asked the banks to rein in speculation in a press release. The board has no disposition to assume authority to interfere with the loan practices of member banks, so long as they do not involve the Federal Reserve banks. It has, however, a grave responsibility whenever there is evidence that member banks are maintaining speculative security loans with the aid of Federal Reserve credit. So, speculate all you want with your money, just don't use our money to do it. But of course, people were using Fed money, and they didn't seem to be trying to stop it. Their press release was mostly ignored. The next month, the Federal Reserve Board tried a new strategy. They stopped issuing statements and started meeting daily in Washington. board members refused to say why they were meeting. But it must be about the markets, right? I mean, they even met one Saturday in March, so it has to be serious. When trading reopened that Monday after the Fed's unusual Saturday meeting, the great bull market of the 20s finally faltered, and the Dow Jones Industrial Average lost 3% on the day. That was bad, but worse was not knowing when the other shoe would drop. Still uncertain as to what the Fed would eventually end up doing, fear began to spread, and the Fed just kept saying nothing. The tension was unbearable. The next day, traders lined up to dump their stocks on the market. Brokers sent out urgent telegrams asking for more margin payments now. The value of the stock they were holding as collateral was crumbling. So speculators needed to borrow more money. But the banks were as scared as everyone else, so they refused. The market was on the brink of collapse. That's when a hero stepped up to stem the tide of the developing panic. Charles Mitchell, the president of National City Bank and a director of the New York Federal Reserve Bank, stepped forward and told the press,
"We feel we have an obligation, which is paramount to any Federal Reserve warning or anything else, to avert any dangerous crisis in the money market."
Then he borrowed money from the New York Fed through National City Bank and loaned it to brokers, thereby saving the speculators and the stock market as a whole. But this was exactly what the Federal Reserve Board had just told bankers not to do. Calls actually went out for Mitchell's removal from the New York Fed. Unbelievably, the Federal Reserve Board in Washington just stayed silent and let Mitchell go rogue. As long as no one was pointing the finger at them, they were content to do and say nothing. Well, one former member of the board did stand up, and he started ringing the alarm bell. Paul Warburg, chairman of the International Acceptance Bank, told his own bank's shareholders that
if the orgies of unrestrained speculation are permitted to spread, the ultimate collapse is certain not only to affect the speculators themselves, but to bring about a general depression involving the entire country.
Of course, he was right, but no one wanted to hear it. They accused him of being out of touch, that he might have a secret short position, and even that he was sandbagging American prosperity by speaking out. Warburg's warning had no lasting effect, and through the summer of 1929, brokers continued borrowing money to loan to speculators. Yale economist Irving Fisher, a very well-educated and smart person, said as late as October 1929,
"Stock prices have reached what looks like a permanently high plateau."
Although, in hindsight, we know the market had already peaked on September 3rd. Then, on October 5th, a man named Roger Babson was speaking at the annual National Business Conference. In his remarks, he told everyone what they already knew deep down.
Sooner or later, a crash is coming, and it may be terrific.
They all knew it, but they were still shocked to hear it said out loud. The Dow Jones Industrial Average fell almost immediately by 2.6% in what's known as the Babson break. What Wall Street needed, now more than ever, was some soothing reassurance that everything was going to be fine. The Wall Street Journal provided it. Price movements in the main body of stocks yesterday continued to display characteristics of a major advance temporarily halted for technical readjustment. Yeah. By this point, brokers' loans to speculators had reached $8.5 billion. How could this continue? Only by the power of positive thinking.
The industrial condition of the United States is absolutely sound. Stock values have a sound basis in the general prosperity of our country. Nothing can arrest the upward movement.
Is it a good time to mention that Charles Mitchell had money riding on this? Big surprise, huh? He was speculating in the stock of his own bank. And in 1933, he was arrested for tax evasion on the sale of that same stock, and he personally had to pay a $1 million settlement worth $26 million today. On Wall Street, stocks continued to slide through October. But people weren't panicking quite yet because they knew that surely Charles Mitchell or someone, one of the big boys, would step in and provide support for the market like he had back in March. That support will come. It's definitely on the way. Early on Monday, October 21st, stocks plunged on a huge volume. 6.1 million shares were traded by day's end. But fortunately, there was a rally late, and the Dow Jones dropped just about 1% on the day. The next day, Yale professor Irving Fisher proclaimed that by now, he thought the market had been cleared of speculation.
Even in the present high market, the prices of stocks have not caught up with their real values. Yesterday's break was a shaking out of the lunatic fringe that attempts to speculate on margin.
Then on Wednesday, early morning jitters turned to cold fear as stocks plunged by noon and just kept dropping. Late in the day, a frenzy started on the trading floor as traders rushed to unload whatever they had. Where was Charles Mitchell? Where was the support? The doors opened Thursday morning, and immediately the selling frenzy continued. 12.9 million shares traded hands that day, obliterating the previous record. Stock market clerks couldn't keep up with the volume, and the stock ticker fell hours behind. People knew it was bad, but they had no way of knowing how bad. Were they completely ruined? No one knew. A crowd started to gather on the street outside, come to see what was happening at the exchange. On Black Thursday, it was rumored that a suicide wave was sweeping through Wall Street, and people said that by mid-morning, 11 speculators had already jumped to their deaths. Now, there were a few suicides, but overall the rumors weren't true. Nevertheless, the idea of speculators jumping from rooftops would become an enduring myth of the 1929 crash. News of these supposed deaths was shooting through both the crowd outside and inside on the trading floor. Finally, the big bankers had had enough. Charles Mitchell and several other powerful financiers joined together at the bank of J.P. Morgan. After some discussion, this team decided to pool their resources to save the market. They gave a huge purchase order direct to Richard Whitney, acting president of the New York Stock Exchange himself. Traders must have cheered when they saw Whitney stride confidently down to the trading floor, putting in orders for stock after stock, thousands of shares each. The support had finally arrived. Other traders followed right behind him as their fear turned quickly to greed. A huge rally followed in Whitney's wake. prices were only down 2% in total by the end of the day. The crisis had been averted. Is this a good time to mention that Richard Whitney was an embezzler who was stealing not just from the stock exchange, but also from the New York Yacht Club and from his own father-in-law's estate? He was sentenced to 5 to 10 years in prison in 1938.
The trouble on the market today was purely technical. Most importantly, you should know the fundamentals remain unimpaired.
The fundamental business of the country, that is, production and distribution of commodities, is on a sound and prosperous basis. When the market reopened that Monday, people expected things to go well. Because it couldn't get any worse, right? Despite the optimism, the Dow Jones lost 12.8% in an absolutely brutal day of trading. But at 1 o'clock, there was another ray of hope. Charles Mitchell was seen at JP Morgan's again, and that news was carried over the stock ticker, causing a short rally. People waited on the floor for Whitney to make his grand entrance, and they waited and waited. But neither Mitchell nor Whitney ever came to the trading floor. Where were they? It soon became clear what the bankers had planned. They were getting out. That Tuesday, they dumped huge blocks of stock, one after another. People expected that they would support the market, but now they were crashing it. It was absolute chaos. The ticker fell 2-3 hours behind as traders scrambled to exit. When the dust finally cleared, bleary-eyed clerks at the exchange got to work on the grim business of counting the losses. They worked all night processing a record-breaking 16.4 million transactions. They even kept working into the next day of trading, with some falling asleep at their desks. Stock prices fell over 20% that horrible October, and they would keep dropping for years. The market collapse pushed the economy, made unstable by inequality, off the brink. Banks pulled back on loans to consumers and businesses, who responded by laying off workers and cutting pay. There was no safety net. By 1933, the country's gross national product had dropped 29%, and construction dropped 78%. 1 in 4 Americans was left out of work, and many faced starvation. Can you imagine how Herbert Hoover must have felt in his first year as president dealing with something like this? It seemed like everything was headed down the drain, but he got some advice on what to do about it from his Treasury Secretary.
Liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate. A panic was not altogether a bad thing. It will purge the rottenness out of the system. High costs of living and high living will come down. People will work harder, live a more moral life.
This was the greatest crisis America had ever faced, at least since the Civil War. Next episode, we'll find out, will the president listen to Mellon's advice and give Americans more of the same? Or would he shuffle the deck and finally give the country a new deal?